In this chapter, we're going to cover the estate tax. And as we covered in the last chapter, and as we know, the estate tax is the second component of the taxation of giving. So the gift tax applies to lifetime giving, and the estate tax applies to dispositions of property at death. They're unified through the unified credit. Again, that's important. If they weren't unified, taxpayers could manipulate one or the other. They could give away taxes during life, give away wealth during lifetimes to circumvent the estate tax, or they could wait until they die and give away all their property at death to circumvent the gift tax. And as we know, taxpayers may pass the basic exclusion amounts tax-free at death, and currently that's $11.18 million. So the total tax on the taxable estate and the adjusted taxable gifts is calculated pursuant to the estate tax formula, and then we get to subtract post-1976 gift taxes, the unified credit, the credit for pre-1977 gift taxes, the credit for taxes on prior transfers, the foreign death tax credit, and then we get the estate tax payable. Here this is graphically. In this chapter, we're going to define what each of these boxes means and then do an example for calculation of the estate tax. So we start with the gross estate, which generally includes all property owned at death, property that the decedent transfers, but for which he or she retains the right to income for life. We subtract deductions, and that's going to equal our taxable estate. From there, we get the taxable estate. To that, we add the adjusted taxable gifts. So we covered that in the last chapter, but we actually add those to the taxable estate to get the estate tax base. And then we calculate the tentative tax on that base, and we calculate that using the unified transfer tax rate schedules. If you have a hardcover book, it's on the back inside cover. If you have just an online version of the book, you'll just have to look for those tax rate schedules. From there, we subtract 1976 gift taxes, the unified credit, the credit for pre-77 gift taxes, the credit for taxes on prior transfers, and any foreign death tax credits. And after we do that, we get the estate tax payable. The gross estate applies to testamentary transfers where the use and enjoyment ceases at death. So the entire estate to which the decedent has access and enjoyment at death is going to be included in the gross estate, and it's going to be valued at the date of death or the alternative valuation date, whichever is chosen by the executor. Adjusted taxable gifts and the tax base are going to be combined. So the adjusted taxable gifts are going to be added to the taxable estate to determine the estate tax base. But the value of those gifts is going to be valued at the date of the gift, not the date of death. And then we calculate the tentative tax on that estate tax base. We use the unified rates, which we've just gone over. And remember, the rates are progressive. So the higher my estate, the more I've given away, the higher the rates. All right, and then that tentative tax that we calculated is going to be reduced for post-1976 gift taxes paid at the year of the gift. And we do that as follows. The unified credit is subtracted from the gift. The unified credit subtracted from the gift tax is recalculated to determine what the credit would have been if the tax rates in effect on the date of death had been in effect at the time of gift. This step is going to prevent double taxation of gifts. The unified credit for taxpayers dying in 2018 is $4,417,800, and it's indexed annually for inflation. We value the estate either at the date of death or the alternative valuation date, and the alternative valuation date is 6 months after the date of death, or if the estate property is sold, the date of sale, whichever is earlier. I choose whichever date, either the fair market value at the date of death or the alternative valuation date. I choose whichever requires a smaller estate tax payment. And all assets must use the same valuation date. I can't pick and choose. Listed stocks are going to be valued at the average of the highest and lowest selling price on the date of death. Real estate is valued at the fair market value using generally applicable appraisal techniques at the date of death or the alternative valuation date. And then actuarial tables are going to be used to value annuities, interest for life or for a term of years, reversions, and remainders. Inclusions in the decedent's gross estate include property in which the decedent had an interest at the date of death. It also includes gift taxes on property given away within 3 years of death, plus certain property given away within 3 years of death. Property the decedent transferred during life, but in which the decedent retained economic benefits or the power to control enjoyment. Property decedent transferred during life, but which for the decedent has too large a reversionary interest. Property the decedent transferred during life, but over which the decedent held the power to alter, amend, revoke, or terminate an interest. Annuities generally, jointly owned property over which the decedent possessed a general power of appointment, life insurance on the decedent's life, and Q-tip trusts for which a marital deduction was claimed by the decedent's spouse. And we are going to talk about each of these in the following slides. So property in which the decedent had an interest includes all beneficial interest, legal title, remainder interest, and then income earned but uncollected. It also might include dower or curtsy rights. These rights provide protection for a surviving spouse by providing the surviving spouse with a portion of the decedent's estate, even if it's not provided for in the will. So this might be when a spouse, say a wife, dies and doesn't leave anything to her husband in the will, and there's no community property because this is a separate property estate. Curtsy rights would provide that a certain portion of those assets go to the husband, even though nothing was left in the will. These are a creature of state law, so they vary by state. Some states don't have them at all. But dower or curtsy rights, the provision of assets provided by dower or curtsy rights are included in the gross estate, but they're entitled to the marital deduction for those assets. These transfer or provisions apply to transfers within a specific time period prior to death for which the decedent did not receive adequate consideration. So there are a few different provisions. The first is Section 2035, and that applies to the following transfers that are made within 3 years prior to death. So life insurance policies on the decedent's life that would have been taxed had they been retained, and interest in property that would have been taxed had it been retained. Items subject to 2035A are dealt with using gross-up rules, and gross-up rules apply to increase the decedent's estate by the value of the gift tax paid on the gift made during that 3-year look back. So the amount of gift taxes paid by the decedent will increase the estate of the decedent. Transfers with retained life estates also are included here. This applies to a transfer for which the decedent kept possession or enjoyment of the property or the right to its income, or retained the power to designate the person who is to possess or enjoy the property or to receive its income. It applies to the above referenced transfers when the power is retained for one of the following periods: for the transferor's lifetime, for a period that cannot be determined without referring to the transferor's death, or for a period that does not end before the transferor's death. If this applies, the amount retained is included in the gross estate at death. Reversionary interest might also be included in the decedent's estate at death. This is going to apply when there's a chance the property will revert back to the transferor, so come back to the transferor, and it applies when the value of the reversionary interest exceeds 5% of the value of the transferred property. And this is valued, an actuary will value this. If we have revocable trust, they're going to be included in the decedent's estate if the decedent has the power to change the enjoyment of the property by altering an interest. And if so, the estate will include the interest over which the decedent had the power to alter. So here, Sue died on May 3rd, 2018. On October 1, 2015, Sue gave her son Tom land valued at $7,014,000. Sue applied a unified credit of $2,117,800 against the gift tax due on this transfer. On Sue's date of death, the land was valued at $9.4 million. So A, with respect to this transaction, what amount was included in Sue's gross estate? All right, so this is a gift that Sue made, and the land at the time of gift was valued at $7,014,000. On her date of death, it was valued at $9.4 million. So the first thing we need to remember is that we care about its value on the date of gift. So that's $7,014,000. So part A, we include in the gross estate these gross up values. So it happened within the 3 years prior to death, so we need to include the gift tax in the gross estate. We do this as follows. So we have $2,745,800 of gift tax on the 2015 $7 million gift. I value that using the current rates. And if you turn to that rate schedule now, you'll see that we value a gift over $1 million as follows. We take the value of the gift minus any amount over $1 million and multiply that by 40%. To that, we add $345,800, and that's where we get $2,745,800 tax. Okay, from there, we subtract the unified credit that she used against the gift. That's given to us at $2,117,800. That's how we get this $628,000 gift tax value that must be added back to the estate, the gross up value. B, what's the amount of Sue's adjusted taxable gifts attributable to the 2015 gift? And what that means, remember, is the value of the gift minus the annual gift tax exclusion in effect in the year of gift, which in 2015 was $14,000. So that's how we arrived at that $7 million adjusted taxable gift value. John died in 2018. What amount, if any, was included in his gross estate in each of the following situations? So A, in 1997, John created a revocable trust, funded it with $400,000 of assets, and named a bank as trustee. The trust instrument provided that the income is payable to John annually for life. Upon John's death, the assets were to be divided equally among John's descendants. When John died at the age of 72, the trust was still revocable. The trust assets were worth $480,000 at the time. So this is a revocable trust, and John had the power to revoke it and to change the payment of the trust assets. So this amount is going to be included in his estate at death at $480,000, which is the value of the assets at death. B, in 2005, John transferred title to his personal residence to a charitable organization, but retained the right to live there rent-free for 20 years. The residence was worth $150,000 on the transfer date. At John's death, the residence was worth $230,000. So here this will be included in his estate because the retention period did not end before his date of death. C, in 2000, John created an irrevocable trust, funded it with $200,000 of assets, and named a bank as trustee. According to the agreement, all the trust income was to be paid out annually for 25 years. The trustee, however, is to decide how much income to pay each year to each of the 3 beneficiaries who are John's children. Upon termination of the trust, the assets are to be distributed equally among John's 3 children. The assets were worth $500,000 when John died. So now this is irrevocable, meaning John cannot change the provisions of this trust or change the beneficiary. So none of this is going to be included in his estate at death. He has no control over the assets or their disposition. D, in 1997, John created an irrevocable trust with a bank named as trustee. He designated his brother Al as the beneficiary of all the income for life. Upon Al's death, the property is to be distributed equally among Al's descendants. The trust assets were worth $400,000 when John died. Again, none of this will be included in John's estate because this is an irrevocable trust over which he has no control or benefits. Okay, continuing on to things that are included in the gross estate. We're moving on to annuities and other retirement benefits. They are included in the gross estate if payments are going to continue beyond death, and the inclusion amount is a fraction of the value of the annuity or the lump sum payment received by the surviving beneficiary, and an actuary would provide the value of these annuities. Jointly owned property is going to depend on who the other owner is. If the ownership is going to involve people other than spouses, then it's included in the decedent's gross estate equal to the portion of consideration furnished upon acquisition of the property. So if this jointly owned property is valued at $100,000 on the date of death and the decedent contributed 10% of the consideration to buy the property, the decedent's estate will include 10% of the fair market value of the property at death. Ownership that involves only spouses, though, is going to be treated as a qualified joint interest, and the decedent's gross estate is going to include half the value of the qualified joint interest. If we have power of appointments, the holder of a general power of appointment must include the property over which he holds that power in his gross estate. And a general power of appointment means the holder can exercise the power in favor of himself, his estate, his creditors, or the creditors of his estate. If the power isn't general, then it's limited. So if it's limited by an ascertainable standard, it's not a general power of appointment and therefore is not included in his gross estate, his or her gross estate. Life insurance is included in the gross estate to the extent it's payable to the estate at death or the decedent held any incidence of ownership in the policy at the time of death. A life insurance policy is includable in the estate if the policy is transferred within 3 years preceding death. These transfers are allowed a consideration offset, meaning the gross estate is reduced by an offset for partial consideration received in certain transactions. If the consideration is received in an earlier transaction for the property that's transferred, the value of the property included in the gross estate is going to be reduced by the amount of consideration received. And we covered Q-tip trust in the gift tax chapter, but the recipient spouse's interest in a Q-tip trust may or may not be included in the gross estate. If a marital deduction is claimed for Q-tip property, the property is generally included in the recipient spouse's gross estate, not the decedent's gross estate. The property is valued at the date of death or the alternative valuation date. Now we're moving on to deductions. So once we get the gross estate, we add that up, and then we are allowed some deductions. The first are debts and funeral and administrative expenses. Mortgages and other debts are deductible if they represent bona fide contracts for an adequate and full consideration in money or money's worth. Funeral expenses are deductible, and administrative expenses of the estate are deductible. Interest, state, and local taxes and trade or business expenses that are accrued at the date of death are deductible on both the estate's income tax return and the estate tax return. Losses are also deductible. These include theft or casualty during estate settlement. And the amount of the loss takes into account the amount of insurance received. So if I'm compensated for that loss, I can't also take a deduction. If the alternative valuation date is selected, the loss may be used to reduce the alternative value and then used again as a loss deduction. The loss can be taken either on the estate tax return or the income tax return, but not both. We're allowed a charitable contribution deduction. Transfers to a charitable organization are deductible without ceiling. And we should pay particular attention when we make a gift to a charity of an entire residual interest, which means everything left over minus estate taxes. That's difficult to calculate. And then also split interest gifts are difficult to calculate. We're allowed a marital deduction, and that's unlimited. To be eligible for that, transfers to a surviving spouse must either be includable in their estate or subject to gift tax if transferred. These 3 tests must be met for property to qualify for the marital deduction. So test 1, inclusion in the gross estate. No property passing to the surviving spouse is eligible for the marital deduction unless the property is included in the gross estate. Test 2, the passing requirement. Property must pass to the surviving spouse in a qualifying manner. It must be received in one of the ways listed on page 1321 in your book. Retirement benefits are also considered to pass if they're included in the gross estate. So, page 1321 will tell you that the property must be received in one of the following ways: either a bequest or devise under the decedent's will, an inheritance resulting from the decedent dying intestate, that means without a will, dower or courtesy rights, an earlier transfer from the decedent, the right of survivorship, an appointment by the decedent under a general power of appointment or in default of appointment, or a designation as the beneficiary of a life insurance policy on the decedent's life. And then test 3, the terminable interest rule. The spouse's interest in property cannot be classified as a non-deductible terminable interest. And that has a non-deductible terminal interest is one with the following features. So an interest in the property must pass or have passed from the decedent to a person other than the surviving spouse, and the recipient must have paid less than adequate consideration. The other person may possess or enjoy any part of the property after the termination of the surviving spouse's interest. Q-tip transfers also allow a marital deduction in cases where the surviving spouse does not control the eventual ownership of the property. So qualified terminable interests are defined as property which passes from a decedent in which the surviving spouse has a qualifying income interest for life into which an election applies, and if the marital deduction is elected on the first spouse's estate, the property is taxed in the surviving spouse's estate or is subject to the gift tax if disposed of during the spouse's lifetime. We're trying to make sure these assets are taxed somewhere in someone's estate. I'm also allowed a deduction for state death taxes. These eligible taxes are going to include estate, inheritance, legacy, and succession taxes paid to estate or DC. The taxes must be paid no later than 4 years after the filing of the estate tax return, and the deduction is for the amount paid and is not restricted to a maximum amount. Okay, so on to computation. We have the taxable estate and the tax base. So we calculated the gross estate and we went through that, and then we're allowed to reduce that gross estate by deductions that we just went through to get the taxable estate. The estate tax base consists of the taxable estate plus any adjusted taxable gifts, and those are all the gifts made after 1976, other than gifts included in the gross estate. Adjusted taxable gifts are valued at their date of gift value. Then we compute the tentative tax on the estate tax base. It's reduced by the decedent's post-1976 gift taxes. The amount of gift tax paid takes into account gift splitting provisions, and the amount of the tax deemed paid is the amount that would have been paid using the estate tax rates for the date of death. This amount is then reduced by the unified credit. We also have what's called portability, and that allows, so the basic exclusion amount of $5.49 million is portable between spouses. So any basic exclusion amount that remains unused at the first spouse's death can be used by the second, and it must be elected by the executor filing an estate tax return for the first decedent, whether a return would otherwise be required or not. So even if the first spouse is not required by law to file a return because their estate is small, they may want to consider filing a return to elect portability. The unused exclusion amount is not indexed for inflation. If a surviving spouse was predeceased by more than one spouse who died after 2010, the surviving spouse can only use the unused exemption amount of the last deceased spouse. So this is spouses who get remarried, and we can only use the portability from the last deceased spouse. This is called the deceased spousal unused exclusion amount, and it applies to all couples, whether same-sex or not. So again, we saw this at the beginning of the chapter. I'm going to show it again. So we start by calculating gross estate, and we went through what is and is not included there. Then we get to subtract deductions. Remember, those were expenses and debts, losses, the marital deduction, the charitable contribution deduction, the state death tax deduction. That's the taxable estate. There we add back any taxable gifts, post-1976 taxable gifts, to get the estate tax base. We use that number in the tax rate schedules to calculate the tentative tax on the estate tax base. And then from there, we get to subtract credits. We get a credit for post-76 gift taxes. We get the unified credit. We get a credit for pre-77 gift taxes, a credit for taxes on prior transfers, the foreign death tax credit, and that's going to equal the estate tax payable. Maria Martinez died in 2018, survived by her spouse, Sergio, and 2 adult children. Her gross estate, all of which passed under her will, was valued at $17.2 million. She had Section 2053 deductions of $100,000. Her will left $200,000 to her church, 20% of her gross estate to her spouse, and the rest to her children in equal shares. She made taxable gifts of $20,000 in 1975 and $500,000 in 1999. The gifted assets have increased in value to $120,000 and $715,000 respectively. Calculate her taxable estate, her adjusted taxable gifts, and her estate tax base. So I want to address a few things before we go through this. So first, these Section 2053 deductions, those are things that are allowed for funeral expenses, administrative expenses, things like that. She left $200,000 to her church. We know that's a charitable deduction. She left some to her spouse. We know she gets a marital deduction. She also made gifts. Notice that the $20,000 is 1975. So remember, when we talk about we get gifts, we talk about post-1976 gifts. So remember that those older ones are going to be treated differently. And then this 1999 one is valued at $500,000. Today, those gifts have increased in value. But remember, when we value them at the value on the date of gift. All right, so we start with the value of her gross estate, which is given to us. It's $17.2 million. From there, we get to take some deductions. We get to take the 2053 deduction. We get to take the charitable contribution deduction, and we get to take the marital deduction. And remember, she gave her spouse 20% of her gross estate, so that's how we got that $3,440,000. All these deductions are allowed without limit. So we subtract them, and we get her taxable estate of $13,460. We have to add back her adjusted taxable gifts post-1976. So that one was in 1999. We add it back at its date of gift value to get her estate tax base of $13,960,000. Remember, from there, we would calculate her gross tax due, and then we would subtract those credits, and she would get a credit for that adjusted taxable gift that she made. She'd get a credit for the gift taxes paid. And also the gift taxes paid, if any, on that $20,000 gift from 1975. All right, Joseph Jernigan died in 2018 with a taxable estate of $4.1 million. He was survived by his spouse, Josephine, and several children. He made taxable gifts of $100,000 in 1974 and $650,000 in 2000. The property given in 1974 was valued at $425,000 when he died, and the property given in 2000 was valued at $400,000 when he died. Again, we don't care about the date of death value, we care about the date of gift value. Determine his estate tax base, his estate tax before subtraction of the unified credit, and the amount of the unified credit available to his estate, the reduction for post-76 gift taxes, and his estate tax payable. Also indicate the amount, if any, of his basic exclusion amount that is portable to Josephine. All right, so his taxable estate, his gross taxable estate is $4.1 million. To that, we're going to add any gifts made post-1976 valued at their date of gift value. So remember, he made 2 gifts, but only one was post-76, and it was valued at $650,000 to get his estate tax base of $4,750,000. From there, we calculate the estate tax before subtraction of the unified credit. All right, and that is calculated based on the unified transfer tax rates, and we get $1,845,800. From there, we're allowed credits. So first is the unified credit. That this year is $4,417,800. I also get a credit for any gift taxes paid for post-1976 gift taxes. So remember, I included the value of the gift prior to calculating the estate tax base. So I get to take this credit down here to prevent double taxation. You can see I get a credit of $3,950,000. Down here at the bottom, you can see how we got that. So the tax payable on the $650,000 gift in 2000 was $224,500. In this text box that I added, you can see it's calculated as follows. So remember, back to the last chapter, we calculated gift tax by looking at total lifetime gifts. So he made a gift of $650,000 in 2000, but he also made a previous gift of $100,000. So total lifetime gifts are $750,000. So if I look at that table, I can see that calculating tax on gifts of $750,000 but not over $1 million is $248,300. So that's where this number comes from. All right, and then I get to subtract, though, tax on gifts made previously to which I have probably paid gift tax. So tax on that gift made previously of $100,000 would have equaled $23,800. Again, I can find that in the unified transfer tax rates. So when I subtract that $23,800 from the $248,300, I get $224,500. Okay, and then from there, I subtract the unified credit available that year. And again, I have that as well in the back of my book. I have the unified credit, the historic unified credit. So in that year, let's see, that year was 2000. So I look at my chart. In 2000, the amount of the credit was $220,550. So that is how we get the post-1976 gift tax credit. We subtract the unified credit from the gift tax, the $224,500, resulting in no gift taxes payable at his death. And there's also some portability, and you can see in footnote A, that's calculated by looking at the estate tax base of $4,750,000, and I subtract that from the basic deduction amount, the $11,180,000. That's each spouse's exclusion added together, right? So they're married, so that $5 million exclusion number that's available this year, I basically multiply it by 2, and then I subtract the amount of the first spouse's death, the amount of the estate tax base of the first spouse's death, meaning that when his spouse dies, the spouse is going to have a basic exclusion of $6,430,000 rather than that $5 million number that single individuals would have.